Well, hello everyone. Welcome to Trading a Smaller Account. It is Friday. I feel like I've been gone forever, but I actually taught this class on Monday. Yeah, I haven't really been gone that long at all. We in this class, it is an active trading class. So we place lots of trades and we follow up on lots of trades. And so that's exactly what we're going to do today. I've got half a dozen stocks we want to look at, several that we're going to place example trades on, and then I've got several positions that are already in the account that we're going to look at, and we're going to talk about how to manage those. I've got Scott Thompson in the chat, and you can't tell anyone, but he's one of my favorite people to have in the chat. I've learned a ton from Scott. He's familiar with all of these strategies. And so if you've got any questions, don't hesitate to ask because between Scott and I, we should be able to come up with answers for you. I want to thank all of you who are here live today and for being so participatory in the chat. So to Paul and Jenny and Kevin and Becca and Abundant, like I love some of these handles, and Jay and Riceberg and BJ and the rest of the gang. Thank you all for bringing this class to life. If you are here for the very first time, feel free to type a greeting into the chat so that we can officially welcome you. We link arms here every Monday and Friday. And are figuring this stuff out together. We reset the account at the beginning of every year. So we started this year with $25,000. Our max position size is 5,000. And our max risk per trade is $500 per trade. So if you are not following Scott and I on X, you're going to want to do that at Barb Armstrong CS and at Scott Thompson CS. And as a reminder, before we get into the thick of things today, we do lots of both stock and option trades. A reminder that options carry a high level of risk and aren't suitable for all investors. We use the Paper Money software application on the Thinkorswim desktop platform. And just to remind you that there are some nuances and differences. One is that short option positions will never be assigned early in Paper Money, and that can happen and I've seen it happen in a live account. Where you can be called out or assigned early. And sometimes that's a beautiful thing. And sometimes you're going like, that I wasn't expecting, Macy is saying it's her first time being able to catch a live. So welcome. We're glad you're able to be here. And we've got somebody tuning in from Colombia. So we literally have people from all over the world. Now, Kevin Horner, and Kevin is off today, so Mike Fairborn filled in for him, but there's a fantastic market overview done at the beginning of 4 out of 5 trading days of the week. So you'll want to catch that. I do a super fast overview so that we can spend more time managing and placing new trades. Okay. Yeah. Okay. And I've already talked about this. Actually, we started this year with 25,000. And well, you may think like, okay, if this is 25,000, 5,000 is it's too big a position size. So we started with 25K, and this represents 20%. And we did this so that we could do like buy right covered calls with stocks that are $50 or less, and a few other things. Oh, that reminds me, I want to look at this one. Fifth Third Bank, which I keep thinking of as Fitbit, just because of the ticker symbol. If you had $1 million account, you might not want any one position size to be more than 5% or 10%, but this is our rationale here. And our max risk per trade is 500. We might go to 525 or 550, but we're not going to, because our account is up this year, but we're not going to go to 600. And our focus is on the short to intermediate term time frame. We're in the moving business, not the storage business. We're not doing a long-term buy and hold approach in this class. So you might have a really large portfolio and you are taking a portion of it and saying, this portion I want to trade actively. And so this class is for you for that portion to develop some skills. And we trade both bullishly and bearishly, depending on what's going on in the market. Okay, so that's that. So let's come and have a quick look at, what's been going on in the market. So if we start with the SPX, and this is going to be like our 2-minute overview, we had this extraordinary move to the upside. And if you look at the last 30 years, the S&P 500 has returned on average, like through all the ups and downs, and that includes 2008 and 9 and 3 or 4 years ago where it was down 18%. It's returned on average about between 10 and 11% a year. And, we're up 20% in the last 40, we were up 20% in 45 trading days. And from, our 6-month low here, our year-to-date low, we're still up 18%, even though we've gone through this period of consolidation and we're bouncing off this support line. If we come in and look, some might call that a bullish harami, and that today's candle body is totally engulfing the body of the candle of the previous day. And if you're new to candlesticks, I've done a bunch of short videos that are in a playlist called the Trade Management Mini Sessions, and you can go and do a little binge learning watching those. I'll show you where those are later in the webcast, but Scott has probably already posted a link to that. He's so on top of things. Anyway, in the NASDAQ, we're kind of flirting with this support level. And, if you had said, well, I see this as more of a pennant pattern, and if you'd drawn a line kind of like that, then you'd say it's breaking down and it's come down to this support level. And some base it on the bodies. James sometimes nicknames himself James Body to Body Boy. But, if we come down here to the bottom of these wicks, it's flirting with this support level. But today's candle is saying, hey, we opened lower and we're currently above where we were trading at the open. And this would be a hammer at support. That's considered a bullish pattern, but we would look for confirmation. But it's a hopeful sign is what that is. And then, where the NASDAQ or the S&P was up, 20% or just over 20%, NASDAQ up 35 and still up 24% off our year-to-date low. Now, what about the Dow? The Dow 30. Now, this is a different index in that it's based on market cap or based on the price of the stock as opposed to market cap. But, it came down yesterday and is rallying today. And it's not a perfect morning star pattern. Usually this candle would be bigger, but then we have a candle of indecision and then a big bullish day to follow. So this is considered to be a bullish and really a tradable candlestick configuration. Okay, when we look at the VIX, our VIX is sitting at 17. So, it's kind of in that kind of midpoint of where it's been trading most of the year. So, it's down, 6.7% today. Yeah. So if we come and we look at our indices, and I'm bringing this up for a reason, because we're going to look at, when we look at our certain stocks, for a long time, tech was kind of hogging all the glory. But when we look at this last 3 months and, it's really healthcare that's been leading, and healthcare up today. Technology in second place, but technology for a lot of the last couple of months has been kind of consolidating after this big run to the upside. It looks very similar to the NASDAQ and the S&P, doesn't it? Yeah. And financials, are close to their all-time highs. And, some might say a bit of a bull flag type pattern. Looks like it's setting up on the chart, but up nicely today. And industrials, you'll notice financials up a modest 2.5%. Technology is year to date up 17%. Healthcare up 5%. But industrials are up 18%. They've actually been the strongest sector year to date. And in the last 4 weeks, what's rotating into favor? Energy again, because of what's going on in the Strait of Hormuz. It's just had this, all of a sudden, this, walk up a steep hill, quickly. But, if things settle down, it could walk back down that hill. So that's when there are global things affecting the energy sector for sure. And then we've already looked at financials. Okay, So I want to come and look at a couple of trades that we put on. So we'll look at a couple of trades and do a little trade management. We'll place a couple of trades and then we'll come back and we'll do a little more management. But one of the things that we had done was we had put on an iron condor here on Uber. Okay. So an iron condor, if you're not familiar with that, is really a credit spread sandwich, is how I like to refer to it, because we've got a short call vertical here that is successful if the stock stays below 78. And then a short put vertical here at 78, 70 and 68 that is profitable if it stays above the 70. And so, just looking at this, you don't have to be a rocket scientist to figure out that this short call vertical has been really successful so far and the short put vertical has not. Okay. But we don't have to close out this trade altogether. And I remember when I first started as a client back in 2011, I went to a client event and somebody was saying, you have to be careful with iron condors because you can lose on both sides. And so what had happened is they had placed this iron condor, not really understanding the strategy. And when it came down and pressured the short put vertical, they closed it out for a loss. And then it bounced and it went back up and they ended up closing out the short call vertical for a loss. Where really, what they should have done was the opposite. So what we're going to do is like work at not losing on either side. But when we've got this short call vertical, when it's down pressuring the short put vertical, we can close this side out for a profit. And then if it bounces or when it bounces, being optimistic, and it might not, but I'm just an optimistic person by nature. And looking at the charts, let me just clear these drawings. So, whoops, let me try that again. I don't usually use this particular drawing tool. What we have here is a harami or an inside day at a support level. And so we put our strikes really not at the lowest level of support. We would have been better to have put our strikes down here. But given this bounces and is back above the 70 strike by July 31st, we could then close this out and and make a little money on it. So we're not going to close out that side. So what we have to do here when we look at this is come in and say, okay, we can probably close out this call side for about 3 cents because, this side is worth a nickel. This side is worth 2 cents. Okay. And we're not down by much on this, $32. But we're going to come up to our working orders on Uber and we're going to cancel this because what we had said here is we want to close out the whole thing when it's worth 17 cents. And now we've changed our mind and we're going to leg out of this position. So we have to cancel the exit we already had in place. So we're going to cancel that exit. Let me just get rid of our distractions here. And we're going to come back and right click on this to create a closing order. And it's going to give us a whole bunch of choices. And what we want to do is we don't want to close out the whole thing. We want to do the call. We want to buy back this vertical for 3 cents, the call vertical, the 78 and 80 call vertical. And it's going to cost us 3 cents to do that. We're willing to do that. Fire in the hole. So we're legging out. Okay, so now this trade is going to look less profitable if we come back to the monitor tab. We were only down by about $80, but we took our profit on the call side and we're going to exercise patience on the put side. And so much of trading is about patience, right? Right. Okay. So that's that one. The next one I want to discuss is KeyBank. So KeyBank, and this is one where we did a buy right covered call. Okay, so and if it shows 200, if we see the quantity, it means there is no covered call. Well, why is it in the buy right covered call bucket then? Well, because when we opened this trade, we bought the stock at 23.12 and we sold the covered call at $24. And if we look at this, we had an exit in place, but on the 17th of July, so last Friday, this expired worthless. And so we made that 20, we got to keep this entire amount because we were not called out. So this expired. And so we now no longer have a stop on KeyBank, which means we're risking $2,300.12 times two. So we're risking $4,600 because it could technically go to zero. Okay. So we've made this $40. And so the plan was to put on another covered call. But we're sitting, where are we sitting? Are we sitting close to support or close to resistance? We're sitting close to support. But, it would appear that it's come down to this support level that it's been at before. It's been here once, twice, three. It hung out here for a week, came back and kissed it again, and it's come back to this support level. Is it kind of like a favorite hotel? Yeah, so Ella, there's a bunch of chat going on about like where is this account value. It's currently at 29,563 and we haven't been below 30,000 for a long time, since I think February. So we've had a whole pile of calls that have gone wrong. And when I show you the rest of the monitor tab, you'll see that we currently have a lot of trades that are underwater because the market has pulled back and almost every trade we had was bullish. Okay, so this is why position sizing is so important. And we're going to talk a little bit more about that. But so we could sell another call, but given we already own the stock, would we rather sell the call when we're at support or sell the call when we're closer to resistance? Because we had this call that we sold at $24. So, and it's now sitting at 22.77. But in an average day, I put ATR back on our chart, average true range, which tells us how much this stock has moved from top to bottom in the average day over the last 14 days, and it's about 47 cents. So if it were to move up over the next 3 days, say $1.50, we'd be close to this 24 strike, right? And so if we come to our trade tab and we say, well, if we could get 50 cents again, like because the strike closest to where we're trading, if we could get 50 cents for it as opposed to 15 cents to 25 cents selling it now, maybe we ought to exercise some patience. And so that's what we're going to do. We're going to exercise some patience. Okay. Okay. So there we are. And keep in mind, like when you're looking at this account, we don't pay transaction fees. If we have a dividend paying stock, we don't get the dividend in paper money either. And sometimes we get what we call a paper money fill, but it gives us an estimate of where we are. But this is why I say when you have really successful weeks or months, you want to put some aside so that if you go through a period where it looks like you're having more trades that are not successful than successful, you're not blowing up your account. So, when we look at this, and we do have one account where we're underwater more than we agreed to. This is American Airlines, and we're going to talk about this. But if we look at this right now, our long call verticals, we're down by $400. Our buy rights, it would appear that we're down by 696. So we're down in this account right now with our current unrealized losses by $1,600. And it's saying our overall profit year to date is 7,000. But these are just estimates. So there are times, and I really make a point of trying to discuss the trades that don't go well, because I think sometimes we can learn much differently. We can learn more from that. Okay, so this is key. Now, key, we want to still manage, the fact that this could still go against us. So we're going to look at, a recent low or this support level and go put a stop back in. And so we're going to come back to our monitor tab. The intention is we're going to have to take this stop off when we add the covered call, which we still intend to do, but we're going to create a closing order with a stop. And we're going to put our stop at 21.83. So we're putting our stop back on. Okay. Okay, so that's key, and that's Uber. Okay, so I want to look at some new opportunities now. So let's look at J&J. So here is J&J. And Connie taught this class last Friday. And she did a long call vertical on J&J. And when I last looked at it this morning, here's Connie's trades. It is up by 45%. Now, we typically put in an exit at 50%. And if we're looking at why J&J is up, we can come here to our live news and see that they got an approval for a robotic surgery system, and that just came through this week. So, one would imagine that that is a pretty big deal. You can do your own research on that. But, we can see that the market is responding pretty positively to that. In the last 4 trading days, it's up. And Connie put this trade on last Friday, and we're up 45%. So we can do a couple of things. We can wait until it hits 50%, or we could ring the bell and say, you know what, a 45% return on a trade in a week is pretty good. We're going to ring the bell, and we have this diagonal resistance breakout on this and positive news. We might want to wash, rinse, repeat. Now, we could just leave this trade on and still layer in another trade. But the reason that I'm going to take this trade off is, in this one, we bought the 250 and sold the 260. It's now trading over 260. So I want to buy the 260 and maybe sell the 265 or the 270. And so this trade is going to have to come off to do that. So we're going to come to our working orders for J&J, and we're going to say, you know what? Instead of waiting for 740, we're going to ring the bell at 685. So CB 482, we are in agreement. And to do this, we're just going to cancel and replace it, because we're going to exit this and just exit at a different price than we were originally aiming for, but with a nice gain nonetheless. Okay, so we'll wait for that to fill, and then we'll come back and we'll place a new trade on J&J. And in the meantime, today is not officially sponsored by the letter J, but we are going to look at JP Morgan. And JP Morgan came out with earnings. The estimate was 559. They, on their earnings per share, they came out at 770. So it was a pretty bullish, like this is a huge bullish engulfing candle, and it's continued on an upward trajectory since. Now, had we met on this, we might have placed a trade on this Monday and we'd be pretty happy. But at least I don't think we did. Do I have a JP? We don't have a JP Morgan in here. But could we look at this and say, well, what are the analysts saying on this? Well, they're raising targets to 419. It's currently sitting at 353. If we just scroll down and we're just scanning for other analysts, raise their price target to 360. And just because these analysts are raising their price targets doesn't mean they're right. Seaport to 372, Citigroup to 360 from 325. Like that's a big move. But overall, it seems to be pretty bullish. So could we come out here to our trade tab? And even if we look at August, say, well, if we look at the 350 strike, it's already trading at almost 353. So we're $3 in the money. We have a tight bid-ask spread. Our example trading plan says, does it trade 1 million shares a day or more? Check. Does it trade at least 20 times the number of contracts we want to trade? Check. And if we do the 350 and the 355, we've got thousands of contracts, a bid-ask spread around 5%. We want it to be less than 10. So we're good to go there. So if we look at buying our vertical and making this the 350 and the 355, we'd pay 285. Now, if we want to make 50%, we would just take that 285 and multiply it by 1.5. So that's we get out when it was worth 427. You may be saying, well, aren't you leaving like $73 on the table? Yep. And happily. Yeah. So I'm going to come to, so if we wanted to do 2 of these, how much would we be risking? Because we could lose the entire amount, 580. That's a little high. We might go 550. We really don't want to go 580. So we're just going to do 1 contract, single order, first trigger sequence. We're going to right click, opposite order, and we'll make this, I think it'll be 430, 290 times 1.5, 435. And we'll make that good till canceled. Fire in the hole. Put that in our long call vertical group. And then we'll go back and we'll see, has our J&J filled? And we're saying, we want 685 and it's currently trading at 692. So there we go. JP Morgan filled, but J&J still hasn't filled yet. So we'll give that another minute and we'll go on to the next one. JP Morgan, we've got that one. Let's come and look at 3M. So 3M, there was a lot of chatter about 3M on their latest earnings announcement. It obviously, it gapped up, so it had a pretty spectacular day. And then it ran up and came back. So some might look at that as an inverted hammer and have expected it to maybe, fill the gap, but it has not. Like it has really held this spot. So, if we're bullish on 3M, and again, you may want to come and just look at what the analysts are doing, given we just had earnings. So Mizuho raised their target to 180. It's currently sitting at, 171. UBS raised their price target to 218. Goldman Sachs to 202. So, we could do a couple of things. But one is that long call vertical and just say, hey, I think in the next 3 weeks, this might continue to be responding bullishly to that earnings announcement. And if we're bracketing it and trying to do it conservatively, maybe we buy the 170 and sell the 175. Okay. So we're going to buy the 170 and sell the 175. So this does have to go up by, $3.40 a share. So it is directional. But if we're paying 250, we can do 2 contracts. And, again, we don't want to be greedy. So we're saying, hey, if this goes up to 375, we'll make $1.25. We'll leave $1.25 on the table. because we've had this conversation with ourselves and we've agreed that a 50% return is pretty stellar in, under 30 days. And we would be happy with that. We're going to put that in our long call vertical group and fire in the hole. Okay, so let's come back because I wanted to do this J&J. Let's see if we can get it to fill here. The market seems to be driving a hard bargain on this one. Okay, so we'll wait for that one. Now, one of our rules is that we want to get out if the trade goes for us on a long call vertical if we're up 50%. Now, if we're down 50%, we also want to exit. So here's our position on J&J that hasn't filled, JP Morgan that just filled. And often, when you first put a trade on, it will look like it's down a little because, of the spread. We're up 8% on target. 3M, has it filled? 3M hasn't filled yet. So, but it shows us that we have a trade waiting for 3M. But on AMD, CrowdStrike, and Cisco, we are down on these. And so we might say like, hey, we want to get out if we're down 50%. We're not down 50% on any of these. But if you wanted to have a quick look, you could say, okay, here's our long haul vertical. We put it on this day, and it's still flirting with it. But we have a week to go. And so, this stock can move $36. It has moved on average $36 in a day. And so maybe we look at this one again on Monday. Now, Cisco was the other one. And Cisco, here are our strikes. We have until August 21st. So we still have 28 days on this one. In an average day, this one moves 357. So, and it's been, quietly, we had this diagonal resistance breakout. It came back to retest and seems to be moving again to the upside, but we're going to keep our eye on that. So that's Cisco and CrowdStrike. So CrowdStrike, we put this one on here, it looks like, on Monday. So my guess is this was probably a bullish engulfing pattern when we put it on, and then it messed with us. So, but it's come down, and we've got this Harami type pattern or a doji. So this is a candle of indecision at a support level. This is a stock that's up 56% year to date. So this is when we're grateful that we've given this some time because, we still have 28 days on this. So we're going to let it continue to kind of work its way. Somebody's asked about a position on ARM. I'm assuming we're out of that. So let me come back here. Oh, we have a short put vertical on ARM. Okay. So that one we're down on. And these numbers look horrific, but usually you've got about a 3-to-1 risk to reward ratio on this. So this one is trading at 270. So it's gone through both our strikes. So here's where our strikes are here. And I would say, let's look at this one again on Monday. We only have until the 31st. And if it hasn't moved up, we'll close it out one way or the other on Monday. But once it's in the money, because we're through both strikes on this one, that, you would think like, oh, our risk of assignment goes up, and you'd be right. So if we were assigned on this, if we came back and we were told you've just bought 300 shares of or you've just bought 100 shares of ARM at $300, that's a $30,000 position. We don't have $30,000 to buy 100 shares of ARM. So then we'd have to exercise our right to sell it at 295. But in an average day, this stock can move $25. So it could be trading back at 300 on Monday. Yeah. So Trader Joe is asking if we can do a bearish trade. I'll look for some bearish opportunities for Monday. We're not going to do that today, but come back Monday, same time, same place. And we'll look at that. So ARM we'll definitely look at again on Monday. Okay. So now so we've closed our J&J position. So let's come out now to J&J. And the reason that we haven't done a lot of bearish trades is that the market overall has been bullish. So we're coming, it's really counter to what's going on in the market to be trading bearishly. But there are a lot of stocks like Nike and Lulu and Adobe. If we look at these, Nike has been going sideways for months and months. Lulu, but following a big downtrend. Lulu's been rolling down the hill all year long. It's down 45% year to date. Adobe, I believe Adobe's been kind of having a tough go of it also, down 36% year to date. So there are, stocks that are certainly trading bearishly. Okay. But we wanted to look at J&J. And when we look at this gap to the upside, we're just going to repurpose this line now that we're out of this and do something 260. And I thought we'd do a comparison trade here, because if we look at the 260, we still have 4,000 contracts. We have a tight bid-ask spread. It trades more than 1 million shares a day. So people will sometimes say, well, do I do the $2 wide spread or do I do the $5 wide spread? Well, the biggest reason to look at the wider spread is we have more liquidity here. And you'll see we have a tighter bid-ask spread. So we're going to do the $5 wide. Actually, I'm not going to do a comparison on this one now because this is 90 cents. This is more than a 10% wide spread. Or you could do the 260, 270. And here we have like 3,000 contracts and we have a 30-cent bid-ask spread. So if we were to do a comparison, it would be the 260, 265 or the 260, 270. Now, what's the advantage of doing the 260, 265? Is that you have a higher probability of it being above that strike come expiration. You have a 45% probability that it will be in the money at expiration. If you do the 270 strike, you have only a 34% probability. You've got a 69% probability that it will at least come up and kiss the 270, but that it'll stay there. That number's a lot lower. And you've got a 90% probability that it'll come up and hit it on the 265. So your probabilities are higher, but your transaction fees for the number of contracts are also going to be higher. Okay. So when we look at this, the 260, 265, we're paying 270. Well, let's call it 270 times 1.5. So that would be, we'd want to be out at 405 on this one. And again, at 260, we could do 2 of these. But we're just going to do, well, actually, you know what? We'll do 2. How much are we risking if we do that? $536. So we're okay with that. Okay. And we're going to right click, create an opposite. Oops. We have to come down here to first trigger sequence first, then right click, create an opposite order. And we're going to put this exit in at 405. So, and what we're saying to ourselves when we're having this conversation is, I'm willing to pay the extra $1.30 in transaction fees to get in and $1.30 to get out to place a higher probability trade rather than doing the $10 wide, where the probability is lower. Now, if we wanted to compare them, we could come out and say, okay, let's buy a vertical and do the 260, 270, and place that same, but we're risking 465 on this. So we're risking less, but it's a lower probability trade of being in the money. We just need it to go above that long enough for us to get our 50% gain. So that's 470 times 1.5 is $7.05. So we're going to compare these two different strike widths. We're going to create an opposite order. We're going to make this 705. And then we're going to put this note in from ourselves to ourselves. We're putting this in our long call vertical group. And we're going to compare to the $5 wide strike width. And then once this is in, if you want to see your note, and think why did I do 2 trades on J&J? You can come over here and click on this and it will bring up your note. Okay, so as we wrap up, I said I would show you a little later, where we can find, first of all, some example trading plans. And if in the bottom right corner, there's a thing to subscribe. Over 200,000 people have done this, so it's not that difficult to do. When you first come in, what you'll see is what's currently being taught. But if you click on playlists and scroll down, first of all, you'll find there's a playlist for this class. So if you come, you missed last Friday and you want to go back and watch it, you can certainly do that. It's right here, that playlist. But if you come to these trade management mini sessions, I'll be recording another one on Monday in this short video series on candlestick patterns. So we were talking about, a hammer pattern or a doji pattern. Here's a doji pattern. We talked about a morning star pattern. So there's a bunch of short videos if you just want a refresher on those. We also talked about a bullish Harami pattern today. So there's a bunch of those. And then today we looked at a buy right covered call and discussed that. And here's an example trading plan that you can use as a framework from which to create your own trading plan. And then there's also one for long call verticals and short put verticals, both of which we have, example trades on today as well. So that's that one. Okay, let me just scroll back and see if we've got other questions. So Frank's saying, thanks for doing the long call verticals. Paul's saying he doesn't like to go counter trend. There's a reason for that. Somebody's saying they like drawing fibs. Yeah, sometimes we'll base our targets based on fibs. Cisco found support at 50% of the gap. We can come back here. Yeah, I look at this as a diagonal resistance breakout. And in spite of this recent pullback, this stock is still up 48% year to date. So it's been pretty bullish, but that doesn't mean that the tides can't change. Yeah. Okay. So guys, that's so Adam is saying, why are we closing one and opening the same? because we had a 45% profit on that, and our intention was to exit with 5%. And the reason we exited on the J&J trade, because I would have left it on, was because I wanted to buy the 260 to open. And if I had bought the 260 when I already had an order in to sell it, it would have closed out this leg of that trade and made this even wider. So given that I wanted to place a new trade with the strikes intermingling with these, I had to close out the one to open the other. So now we can edit this and say, so that was really like, I like the way you're thinking, because if this had been, say the 250 and the 255, I might have left it. But now we're doing the 260 and the 265 and the 270. So we've got two trades on, and we're starting at 260. So we can, and we want it to go to at least 265. So, or 270, which is just above this previous high here. Okay. So guys, that's a wrap for today. What I request as we close things out is, 1, hit the subscribe channel. 2, hit the like button. 3, follow Scott and I in the Land of X, Barb Armstrong CS, Scott Thompson CS. You can find us over on LinkedIn as well. Have a great weekend. Get out there and hug someone you love. And I will see you again Monday. Up next, I believe, is advanced options. So stay tuned for that. Take care, everyone. Bye for now.